everybody recognizes it. It's like, well, I don't see how is this 100-to-1 gold silver ratio, and how can gold be all-time highs and silver still be, 30% below its all-time highs, and all. Everybody sees that, but it's like, I'm not going to fiddle around with trading silver or anything like that until I see it breaking out, because otherwise, for the last 14 years, it's just been sitting here. So silver needs that moment of inertia. It's still fighting, the banks and their short positions, and I mentioned the commercial short positions in gold going down. Well, they're adding it on in silver, trying to cap it, so they don't get squeezed. Once silver starts to take on that momentum and it starts to go, back in 2011, it got from 18, and then a month later it was 28, and then a couple months later it was 38, and then a month later it was 48. That inertia is applied and it starts to accelerate. Well, that's coming.
Global silver mine production continues to trend downward, with output in 2025 projected to be 7.23% lower than 2014 levels. Since 2019, the silver market has faced persistent annual deficits, and this year is no exception. Estimates suggest a shortfall of approximately 117.7 million ounces in 2025, underscoring ongoing supply-demand imbalances. CraigHemke, founder and editor of the TF Metals Report, has been vocal about this growing physical deficit, noting that the market has experienced a cumulative shortfall of around 700 million ounces over the past 4 years. Despite these stark fundamentals, silver has yet to reflect the full extent of this tightening supply in its price. Silver just closed out June with one of its strongest monthly performances in modern history, defying seasonal norms. This midsummer strength is notable given that silver typically underperforms during this time of year. What makes this rally even more remarkable is that silver ETF demand is now outpacing that of gold, suggesting that investor interest is surging from outside the traditional sources. Hemke believes this momentum may trigger a broader rush into silver. However, the metal remains underappreciated and undervalued relative to its historic norms. The gold-to-silver ratio continues to reflect this imbalance, with gold trading at all-time highs while silver lags considerably behind. This dynamic points to silver's significant catch-up potential. On Friday, silver traded sideways, holding steady at $36.84 per ounce due to thin volumes as U.S. markets were closed for a holiday. Yet, underlying sentiment was shaken by renewed concerns over trade tensions, especially following the approval of the One Big Beautiful Bill, which continues to shape market narratives. Hemke argues that silver may be on the verge of a major breakout. Key technical indicators, including monthly and quarterly closes, are approaching thresholds not seen since 2011. Should silver begin closing at or near all-time highs on a sustained basis, it could draw in substantial institutional capital and catalyze a long-anticipated upward move. Make sure to tune in for our expert analysis. Don't miss out on future content. Hit the subscribe button and turn on notifications to stay in the loop. Your support is greatly appreciated.
Physical supply-demand dynamic is clearly manifesting itself, at least even in the current structure of price and how price is discovered. And what we all wait for is, this kind of breaking point. What did Andy was $700 million or 700 million ounces of physical supply deficit over just the last 4 years alone? And we've got to be at this, I don't see where that's slowing. We're not increasing mine supply. And again, so much of silver mine supply comes from mining of copper and zinc and all these other metals anyway. But you get to where the demand, the physical demand, whether it's from investors, which is still, not that great, but from industry, and not just, U.S. industry or whatever. Global industry, whether it's solar panels, these, Samsung EV batteries that might be able to quadruple the life of an EV battery that's, mainly based in silver. There's a point coming, and I think we'll see it when some company just says, like you said, Andy, they're just going to take it all in house. It's like there was a point coming for McDonald's when they finally said, you know what, we're going to have to grow our own potatoes. And they do, right? They said, we're not going to take, we're just going to go straight to the source. We're going to grow our own potatoes and we're going to build our own rail lines and we're going to do our own processing plant. We're not just going to buy the finished French fry product and put it in our fryers. And that's coming for silver. Someone, whether it's at the sovereign level or whether it's a big company is going to say, look, we just can't take it's one of multiple components of our product, but we can't build the widget if we don't have all of the product, all of the components. And we're going to have to take this in house. And when, that kind of thing starts happening, that might be the one that sets off a rush as well. But in the interim, Silver, the line I like to try to explain to people is silver is like, what is it? Newton's law of momentum or whatever it is. Shit, Andy, I should just look this up so I can spout it, chapter and verse and not look like such a dope. But remember, an object at rest remains at rest until force is applied to it, right?
Yeah.
It'll just sit there, but something's got to shove it. And then it's like a rock falling down a mountain. It'll just sit there. But if you give it a shove, away it goes. That's kind of what silver's like. Everybody recognizes it. It's like, wow, I don't see how is this 100-to-1 gold silver ratio, and how can gold be all-time highs and silver still be 30% below its all-time highs, and all. Everybody sees that, but it's like, I'm not going to fiddle around with trading silver or anything like that until I see it breaking out, because otherwise, for the last 14 years it's just been sitting here. So silver needs that moment of inertia. It's still fighting, the banks and their short positions, and I mentioned the commercial short positions in gold going down. Well, they're adding it on in silver, trying to cap it, so they don't get squeezed. Once silver starts to take on that momentum and it starts to go, back in 2011, it got from 18, and then a month later it was 28, and then a couple months later it was 38, and then a month later it was 48. That inertia is applied and it starts to accelerate. Well, that's coming. And the last thing I'll add to that, because again, I could just go on and on. For everybody listening, recall gold, ran up to about $2,000 an ounce in response to COVID and everything, and then went sideways for 3.5 years under $2,000. And everybody's just waiting, and debt continues to accumulate and all this stuff is just going sideways. Well, then finally, right at the end of 2023, it begins to break out above $2,000. New high monthly close, new high quarterly close. And then once we got, really got breaking out on the 1st of March last year, 2024, took off through 2,100. It went to 22. And then within about 6 weeks, it was 24. And it's just been ever since. Well, silver's got that moment coming too, where it will catch everybody's attention. By the time folks watch this, it's July. And I would encourage everybody to go back and look. I don't know where it's going to be, but at the end of June, silver is very likely to have printed a new month, for at least a new monthly closing high going back to 2011, like October of 2011. It's not going to do a new monthly all-time high. That's up the end of April 2011 at 48. Now, silver is also getting close to painting a new quarterly all-time high. Probably didn't happen here in the second quarter, but we're working on it. That's about 37.60 or something like that. Now, I mention that because, again, that's all part of the momentum. Traders will sit there and, look at the hourly charts or maybe the daily chart. But the really big institutions, and we're talking, it's still a pretty small market, the home offices, the hedge funds, they're going to be looking at the long-term chart like they did with gold. And when gold broke out in early 2024, it's just been cooking ever since. Well, that long-term chart, the monthly chart, the quarterly chart, if we get to the end of this year, you realize, Andy, the all-time high annual close for silver is only like 32. So we get to the end of this year and we're printing monthly, quarterly, annual all-time highs. At the risk of making it sound like, it's always next year. We could really, that could really light the fuse. So in the interim, we'll watch the monthly highs, the quarterly highs, and we'll see if we can't get the beginnings of that shove. It's been a great year so far, but silver should be moving, as you know, about twice as fast as gold, that kind of thing, and it hasn't. That gold silver ratio shouldn't be 100, maybe 50 or 60 or whatever. To get that shove, we need to just keep grinding higher and painting those charts. And hopefully that's what we'll continue to do. And what did we do? 15,000, 16,000 contracts in May. So that's about 80 million ounces. Again, though, that's 3, 4 times, 5 times what it used to be. And again, because if you can't get it timely out of London or any place else in the world, then hell, you show up in COMEX. Go long, fully fund that thing, and then just wait and, take your delivery. But it's gradual. No one's showing up, and there's not going to be 100,000 contracts still open, that kind of thing. And again, there's kind of a disservice that gets done because, I've been doing this long enough that you get a little more realistic about things, but I still see stuff on Twitter, people are like, oh yeah, to the moon and all that kind of stuff.
Yeah, really.
Well, I can make a case, sure. Yeah, $100 silver at some point, but it's not going to go from 38 to 48 once we get through 36, the next resistance is 48. Well, no, actually it's probably going to be those stairs that you're talking about. That's just kind of how it flows. It's like 2 steps forward and 1 step back. We're making progress. And the leverage of the system continues just to get stretched and stretched and stretched. And like I said, those underlying physical supply demand fundamentals are irrefutable. And so it's definitely changing the rules of the game. It precludes the banks from just comfortably sitting there spoofing in their contracts, and applying massive naked shorts and then, running the stops and then covering them back up, and all those games that those precious metals desks have played for decades. It precludes them doing it indefinitely because, again, as that ECB note regarding gold, you begin creating kind of a systemic risk, not only to the system, but to your individual bank. And so as those games wind down and stop getting played, well, then again, we're moving that much closer to an actual price discovery too.
Silver has long been considered one of the most manipulated metals in the financial markets. Since the dramatic price collapse in 2011, when silver was driven down from over $50 to around $11 and then held flat for years. Many analysts have argued that such moves were far from accidental. Instead, they point to deliberate actions by powerful institutional players designed to suppress sentiment and crush momentum in the market. CraigHemke maintains that despite the years of manipulation and investor frustration in the precious metal space, the smartest move hasn't changed. His advice is to stay focused on the long term and continue acquiring physical silver. According to Hemke, accumulating tangible metal remains one of the most effective ways to protect against the looming monetary reset and the persistent erosion of fiat currency purchasing power. Silver occupies a unique space in global finance. It is not only in high demand for its industrial applications, especially in sectors like solar energy, electronics, and electric vehicles, but also continues to attract investment interest. Its dual nature, coupled with frequent price suppression, presents a compelling opportunity for long-term buyers. Hemke emphasizes that retail investors can learn from institutional behavior by strategically buying during price dips. Let's get back to the interview.
I just feel like I have to keep emphasizing for people at my site and, in our discussions over the years, and to use Kinesis and any other platform that gets metal out of the existing system and into your hands and away from the banks. But we can all sit here, and too many people do, and they're this close to their screen, right? And they're watching the dot bounce all over the place, right? And they're trying to count their waves and do all this other crap, right? Trying to trade. But when you step all the way back here, right, we'll be able to look. Now, again, maybe not by the end of this year, I don't know, but we'll be able to look back and go, the signs were there that this was, the Financial Times article. Like I said, you mentioned that note from those economists at the ECB, officially on the ECB website about a month ago, warning about the counterparty risk in gold derivatives. Okay. And then you said, these banks that are all of a sudden talking price higher, the ones that aren't the major shorts like Citi. And why wouldn't they, for God's sake? Andy, I keep track every month. The U.S. Treasury Department puts out what's called their monthly Treasury statement. It's usually, I think it's like the 8th business day of the month or whatever. And we always run a deficit, except for April and sometimes, one other month. I can't remember what it is, October. Anyway, the most recent, the U.S. fiscal year begins on October 1st and ends on September 30th. So we're now 8 months into the fiscal year. The most recent report for May came out back on the 10th of June. For May alone, Andy, was $316 billion deficit for just the month of May. Now that's pretty easy math, right? There's 31 days in May. So that's $10 billion a day. It was like $116,000 a second of new deficit. We're running a pace, I kept trying to tell people this Doge thing is just nothing but smoke and mirrors. It's never going to work. It's not going to work politically. It's never going to be codified. Now we've all figured out that's the case 6 months later. We're still running 8% ahead of the run rate for last year, which was $1.8 trillion. And so the U.S. going to come close to a $2 trillion deficit this year. That's not slowing. You can't slow the train. It's only getting worse. And that's in a period of alleged economic expansion, right? So when you're faced with that and you're a banker You just got warned about these existential threats to the system. You'd think somebody above the precious metals desk would go, hey, wait a second. Are we still short? Are we still playing that game? Picking up some nickels in front of the steamroller, Yes, sir, that we are. Why don't you get the risk control, the compliance people down there, see if we can't. We got to get from under that position. And that seems to be what's happening. And so it's very easy for me still after 15 years to get distracted and frustrated and angry because you see these banks doing this stuff on a daily basis. But if we continue to focus on the long term and continue to gradually accumulate physical metal, ahead of this repricing, this resetting, this monetary madness, we're all going to turn out, at least protected. And this idea, again, I just come back to this and I'll be quiet. This idea that gold's a crowded trade or overbought just because prices moved up, that doesn't mean squat, man. Here, Andy, we've done this before, right? My gold bar. Now, look, don't come to my house, right? Okay, it's a piggy bank, right? Okay, but I love using this as a prop because if this were, in fact, a 400-ounce London good delivery bar, and it's not, but if it were, when Nixon closed the gold window and it stopped being sold at $35 an ounce or even, the $42 an ounce that U.S. still carries it at, it took you about 14,000 U.S. dollars to acquire this. Okay. 25 years later at the end of the century, took about $110,000 to acquire this. Has this changed? I mean, no. It now instead of 14,000, it's 110,000. Well, now it's like $1.2 million. This hasn't changed. This is just your standard of measurement. What has changed is the amount of dollars it takes to acquire one of these babies. Okay. So what we all need to do is protect against that constant, incessant, devious devaluation of your purchasing power by owning not one of these, but anyway, you get the idea. In some regards, there's kind of a transparency in the U.S. that we didn't have for 4 years. You'd never see Biden, right? I mean, rarely did he ever hold a press conference or anything like that. And heck, this Trump guy's out there 2 or 3 times a day. You'll be sitting there just minding your own business, watching the markets trade. Then all of a sudden everything goes haywire. And you're like, what the heck? And you realize, well, Trump was getting on, his helicopter and lobbed a few verbal bombs or actual bombs. And it's just kind of the new normal we're going to have to deal with again for a while. It's like, Andy, remember 5 years ago or 6 years ago, it seemed like the big high frequency trading algos were all programmed to scan the headlines. And anytime anything came up that said China trade war, everything would just pop off one way or the other. And now it's like anything that has to do with tariffs, everything pops off one way or the other. The trade around the 12-day war, as Trump wanted to call it, was unique in that gold shot up higher the first 36 hours or so and then didn't do anything. In fact, just kind of washed away the whole next week. And then when the headlines hit that it was over, then all of a sudden gold gets smashed for another $70. In fact, actually ends up falling from the time when the headlines first hit on the 12th to the time when the ceasefire kicked in. Gold was actually down $100. So, I guess in the end, Andy, it augurs just kind of, what you and I have discussed for over a decade, which is kind of the long game. The headlines will drive you crazy, the month to month option expirations and, everything else that goes with it. But as long as we've identified the long-term trend correctly, and I think we have, then we're barreling toward this kind of what I've always called the end of the great Keynesian experiment, this debt-based monetary system that kind of, you have to just feed it increasing loads of fiat currency or the thing implodes. And that's, as long as that trend continues, there's no stop in sight, then we just kind of just keep riding the wave higher. And that's about all we can do.
From a technical perspective, silver is currently taking a breather in its recent rally, though its overall bias remains bullish. The formation of a double bottom pattern signals continued upward potential, indicating that the recent consolidation may be temporary. However, the appearance of a doji candlestick suggests hesitation among traders, often signaling a pause or potential reversal as the market reassesses direction. Traders are closely watching the next key resistance level, the year-to-date high of $37.31. A break above this level could confirm renewed bullish momentum. Momentum indicators, particularly the relative strength index, support the bullish outlook. Overall, the technical setup suggests that the path of least resistance remains to the upside. Scarcity is beginning to speak louder than speculation. With mine output shrinking and structural deficits mounting year after year, silver appears to be standing at the edge of a long overdue revaluation. While price manipulations and institutional inertia have held it back for over a decade, fresh momentum, from ETF inflows to technical breakouts, is reshaping sentiment. This rare blend of industrial necessity and monetary refuge may be setting silver up not just for a rally, but for a historic reckoning. Could the combination of deep structural supply strain and renewed investment appetite finally trigger silver's long-anticipated breakout? And if so, what would it take to sustain it? Share your perspective in the comments section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.